7 million Ukrainians have fled the country, a crisis that has resulted in sanctions disrupting exports from the region. Well, it was clear from the start that Putin's war in Ukraine would be a global economic disaster. The economic knock-on effects of the Russian war are going to be felt throughout Europe. But which countries will be hit the hardest and why? The economic shock. First, countries in Central and Eastern Europe are in a tough spot for a few reasons. They rely a lot on exports, get much of their energy from Russia, and are sensitive to higher prices for energy. Second, Germany and Italy are notable because they depend heavily on Russian gas and might face problems in their car industries due to supply shortages. Third, the impact of higher energy prices varies among EU countries. It would be tough for poorer Eastern countries with cold winters, but even wealthier Northern and Eastern European nations with energy-heavy economies would feel the pain. So, to stay united, the EU might have to share the challenge equally. Exposure to trade disruptions, low but concentrated. The war is messing up trade between the EU and Russia. The EU's direct trade penalties only affect certain areas like weapons, special goods, and the aviation and space industry. But putting financial penalties in place, especially kicking 7 Russian banks out of SWIFT, will make trading way more expensive, except for energy stuff. Just to give you an idea, when Iran got a complete SWIFT ban, their trade dropped by almost a third. Also, lots of companies are cutting ties with Russia, even in areas not hit by sanctions, probably because it is really bad for their reputation to keep doing business there. What does this mean for the EU? In general, Europe doesn't rely too much on trade with Russia. Even though the EU is Russia's biggest trading buddy, it makes up almost half of what Russia sells abroad. Trading with Russia isn't a big deal for the EU, except for energy stuff. Also, trade has been going down steadily since Russia took over Crimea, and the EU put some economic penalties in place back in 2014. Energy imports and rising energy prices. The second big way the Russian invasion of Ukraine will mess with the EU's economy is by making energy prices go up. There are 2 reasons why member countries will feel it. First, because they directly rely on getting energy from Russia, and second, because the prices of gas, oil, and coal everywhere will likely go higher because of the war. Firstly, the EU leans a lot on getting energy from Russia. In 2020, they got around 23% of their oil, 40% of their natural gas, and almost 45% of all of their coal from Russia. Notably, while trade in other areas has been dropping since Russia took over Crimea and the war started in Donbass in 2014, the import of gas and coal has been steadily going up. But this direct reliance isn't the same for all countries in the EU. Just like with overall trade, countries in Central and Eastern Europe depend much more on getting energy from Russia compared to the rest of the EU. For instance, Latvia and the Czech Republic get all their gas from Russia. Similarly, Latvia and Hungary mostly rely on Russian imports for natural gas, while some northern and southern countries aren't as dependent. It is crucial to mention that these imports aren't directly impacted by any financial or trade penalties right now. Actually, both the EU and many other Western friends have clear exceptions for energy-related stuff in their current sanctions. However, talks about expanding economic sanctions to include oil and gas are in progress. There are reports that some Western companies are already making it tough for Russian companies to sell their oil abroad by choosing not to do business with them. Also, there's talk about Russia hitting back with sanctions that specifically target energy exports. Now, the question remains, how exposed would different member states be to such a widening of energy sanctions? In the short term, it would be especially tough for countries that really depend on Russian natural gas. Since gas moves through pipelines and other physical structures, losing imports would be even harder to make up for compared to other energy sources. Away from that, inflation could worsen poverty. Ukraine and Russia are big suppliers of energy and farming stuff. The war is messing up production places, and that's making the prices of key things go up, especially the ones that are hard to replace, like wheat, fertilizers, and gas. Now, they are saying inflation in the euro area might go over 6%, up 2.5 percentage points from what they thought a few months ago. These higher prices can make people buy less stuff. Our estimates say that if the war makes prices go up by about 2 to 2.5 percentage points, real private spending in the EU could drop by 1.1%. And here's the big thing. The higher prices for food and energy will really hit poor families. The EIB Economics Department looked into how these rising prices would affect EU families, especially the ones most at risk. They thought about countries where the basic stuff people need is more affected by food and energy prices, mostly in Central and Southeastern Europe. They also assumed that oil prices would stay high for a few months. Lastly, they thought about how much money families can save and if they can use those savings to deal with the higher prices. The model they used shows that the jump in food and energy prices hits low-income families more in different EU countries. Families with lower incomes in the wealthier Northern and Western European countries can handle the price increase better because they tend to save more and have higher incomes overall. Also, banks are under pressure. The war is making some European banks, like Raiffeisen, think about leaving Russia. But overall, European banks don't have too much direct connection to Russia and Ukraine. By the end of 2021, European banks had about $76 billion in exposure to Russia through loans, advances, and debt securities, and $11 billion to Ukraine, according to the European Banking Authority. Austrian, French, and Italian banks were the most involved in Russia, and French, Austrian, and Hungarian banks have a significant role in Ukraine. However, only Austrian and Hungarian banks said that these two countries made up more than 2% of all the money they lend. Generally, banks have made sure to have enough money set aside in recent years so they can handle any losses in the region. Right now, the biggest risk comes from banks being connected to sectors like chemicals, transport, food, and agriculture that are most affected by trade problems. On average, only 30% of EU bank loans went to these at-risk sectors. The real danger for the economy is if banks stop lending money. Going interest rates are already making loans cost more. In Central and Southern Eastern Europe, the rules of getting a loan have started to get stricter. The pressure on EU companies could also make the quality of loans go down, and that might make banks not want to lend. It is a tough situation for EU companies that are already dealing with a lot. Thanks for exploring the EU situation in the Ukraine-Russia war. If this got you thinking, here's a simple one for you. Did learning about these global changes make you think differently about your own wallet? Share your thoughts below, and don't forget to hit subscribe for more bite-sized insights. Catch you in the next one!